bi-monthly. Whatever topic we discuss during our daily tips, we invite our experts in that field to come and have a practical session for us. And for this month, we've been discussing investments. Quite timely. We all see that globally and even locally in our economies, a lot of changes are happening. For once, we are seeing inflation recording double digits. And from the look of things, it doesn't look like it's going to end now. And in the midst of all this, as individuals, as entrepreneurs, as organizations, we ask ourselves, what is the best options for us to invest in? Should we keep it liquid? Should we keep it in landed property? Should I just keep my money in the bank or keep it at home? These are some of the questions that our audience had reached out. So for today's session, we'll be talking about knowing the investment options that suit your lifestyle. We all know that our lifestyles differ depending on your current situation, what you intend to gain in future as well. So for today, we'll quickly go through our program lineup. So from 6 to 5, 6-5, we allowed for people to log in. Then we'll quickly do the introduction. Then we delve straight into the discussions within 30 minutes. But for today's session, please pardon us. We might exceed the 30 minutes to 45 minutes because we'll do 30 minutes presentation and 15 minutes for Q&A sessions. So ideally, we should be closing by 6:50. But depending on the discussions, we are hoping to close by 7 o'clock today. Okay, so for such a topic, someone will ask, who is the suitable candidate that we got for today's session? Let me introduce our speaker, Seyram Akufo-Wiatta, also known as the investment friend. She is an investment and personal finance enthusiast with over 8 years experience in fund management, with focus on pensions and wealth management. She has a demonstrated history of working in the investment banking industry in Ghana. Seyram has a BSc in Business Administration and an MSc in Industrial Finance and Investments. Currently, she works as a portfolio manager in a leading investment firm. Welcome, Seyram, to Finance Gem Practical Session.
Hi, Jemima. Hi, thank you for the introduction.
And thank you for honoring our invitation.
You're welcome. My pleasure.
So, Seyram, this is your audience. You take it up from here.
Hi. Okay. Hello, everybody. It's good to be here. So I'll just go ahead and then maybe share my screen.
Okay.
And then we can just delve right in. Okay. Just unfortunately, my internet services can be terrible. So just to maintain the quality of the call during the presentation, I will turn off my camera just so we can have some quality in the call.
Seyram, just before you continue, please, this session will be recorded because we'll put up the session on the Finance Gem YouTube channel. So if I could ask for your permission, this particular session will be recorded.
That's fine. That's okay.
Oh,
Thank you.
thank you very much.
Okay, so as we know, my name is Seyram. I've already mentioned the topic we are doing, knowing the investment options that suits our lifestyle. So basically, we'll just run through what an investment is, some of the reasons why we invest. I'm sure a lot of us will be familiar with that. Some considerations when it comes to investing, and then we delve into the meat of the issue, which is the types of investments available. Then, yes, we look at the regulatory landscape because sometimes we get confused as to where to go or who regulates whoever we give our monies to. So what is investment? Investment is basically an asset or anything that you have acquired with the goal of generating an income or appreciation. So it could be landed property, it could be an asset, a financial asset like a treasury bill. If you purchase a car with the intention of using it, for instance, as an Uber, it is going to bring you income. So it is an investment. So usually when we talk about investment, a lot of people just narrow it down to financial assets like treasury bills or bonds or stocks. But anything that brings you income is an investment. So why do we invest? Pardon me if I seem to be rushing through it. It's just that we'll be spending a lot of time on the options available. So forgive me. Yeah, so why do we invest? So yes, number one, to satisfy future needs and goals. So if you have certain goals, you want to purchase a car, you want to travel, you want to pay school fees, you want to pay Ivy League school fees, you save or you invest towards those goals. And for a good retirement, unfortunately, most of us are coming from a background where we find that our parents who are now on retirement are now dependent on us. So for us not to repeat that cycle or to break that cycle, we are trying to ensure that by the time we retire, we have a good investment and so that we don't equally depend on our children. Another reason why we invest is to earn higher returns than savings. So as we know, nobody makes wealth through savings. Your money, the best a bank account can give you is about 5% per annum, which is very, very small compared to how much you would make if you were investing. Another reason why we invest is to preserve the value of your money. I'll talk about this later in the subsequent slide. So let me just skip on that. And then also passive income. This is the goal. Personally, this is my goal, to make my money work for me. I don't want to be actively working throughout, in fact, especially throughout my retirement. I should be able to sit down and then have my money work for me without me physically being present. So a way to create passive income is through investment. So one of the considerations that we talked about, when it comes to preserve the value of your money, comes to inflation. So a cedi today is worth more than one cedi tomorrow. I'm sure now we have been hearing inflation. As it stands now, the figure for May was 27.6%, which is really high. Unfortunately, we are not in normal times, especially from recovery from the COVID-related issues, in addition to the Russian-Ukraine war. You know that Ghana is import driven. So these factors, the COVID issues related to the Ukrainian war, Russian-Ukrainian war issues, have equally impacted our cost of living, has impacted our domestic economy. So inflation is currently off the charts. Whatever you could buy a year ago with your 100 cedis, today you can no longer buy that same product because the value the money that you had, the 100 cedis now that you have, can no longer buy the same number of goods that it could buy last year or the previous years. And this constantly, inflation is not alien to us. It's not only peculiar to Ghana. Globally, as it stands now, the high inflation is going up. I think US also recorded the highest inflation in a long time. I think it's around 8% now. So yes, you need to invest, because if you keep your money in your savings account, you are just basically losing value of your money. So then another thing you need to consider is the risk return dynamics. Before you invest, I'm sure a lot of us have heard this adage: the higher the risk, the higher the possible return. I say possible because it's a possibility. So if you are somebody who personally likes to take a lot of risk, it is possible that when there are certain investments, if you take stuff like Forex or cryptocurrency or even the stock market, those investments come with very high risk. So when the returns are usually coming, you are making a lot more returns. And then also when the risk, the situation turns to, you realize that you make a loss. When you invest in securities that are low risk because of your lifestyle, if you are somebody who doesn't take a lot of risk, you have no business going to look for high return, because your return is commensurate to the risk, your risk appetite. When I talk about risk, so the risk in this case is the possibility that the investment will not meet your expectations, the possibility that you may lose all or some of your money, and then also you may get higher or lower the return anticipated. So these are the risks when it comes to investments. If you recall, a few years back, we had the men's gold issue. People were making about 10% every month, right? Which was really high return. But then a lot of people only focused on the return part and not the risk part. And then when the thing subsided, now people were upset. Meanwhile, when they were enjoying the high return, they forgot that there was also the risk that they could lose their money. So it works hand in hand. You have to know yourself before you go into an investment vehicle. So what is return? Return is the reward for taking the risk or the profit that you make on the investment. The returns can come in the form of interest, in the form of the growth in the value of the security or the asset. And then also it could come in the form of dividends. Dividends, when you invest in shares, I'll delve into that later. When you invest in shares of a company, realize that when the company makes profits, right? If you take, for instance, MTN, if you buy the stocks of MTN and MTN makes profit, MTN can decide that they will give some of the profit to you, the shareholders, who are the owners of the company. So then that comes as a form of dividends. So so just briefly, want to look at the components of an interest rate. So if you want to do an investment, somebody tells you that, okay, I'm going to give you an interest rate of 30%. What does that 30% mean? The 30% will constitute three main things. First of all, it will constitute the risk-free rate. Risk-free in this case is going to be what government of Ghana is offering at that same investment. Okay, that is your risk-free. Then also, you are also going to look at inflation. How much more are you making on the investment? That is, if you just suppose it against inflation, what is your real return? Because if right now inflation is 27.6, and unfortunately we are not in normal times, I've hinted that if inflation is 27.6 and you go and do an investment at 12%, really it doesn't make sense. Okay, because you are still at a loss. You are not nowhere near breaking even or making a real return. Then risk premium is how much more the company would how much more a company will probably add to your investment because they are riskier. So for instance, if you want to do a government of Ghana, say 182-day treasury bill, which is around, let's say, 20%, right? And instead of giving your money to governments, when you do treasury bills, it means you are lending your money to government. Instead of giving your money to government, you decide that I'll rather give the money to Jemima Company. Finance Gem, yes. And the Finance Gem says that, okay, government is giving 20%. So let me give you 22%. That 2% on that Finance Gem has added to it is your risk premium. So you have to ponder and ask that, okay, this extra 2%, is it worth me giving my money to Finance Gem? So when somebody is offering you an investment of, say, if treasury bill is doing 15%, for instance, and then someone is giving you for the same duration, someone is giving you 40% or 30%. If you look at that difference, you realize it is very high, it means that the person is just trying to tell you that I'm very risky. So for that extra risk that you are willing to take with me, I am going to give you this additional interest or this premium. So that is your risk premium. So these are, this is as at 10th June, as at Friday, these are how interest rates have been played. Again, as I said, we are not in normal time. So you realize that the 91-day, 182, 364-day treasury bills are all very high than the very long ones. It's because of the current times that we are. If we had gone back to March, 91-day treasury bill was around 12%, between 182 was around 14%. So we kind of had a normal curve, yield curve. As it stands now, we don't. And just a few more things. So I find it that sometimes when you talk about interest rate, so we have simple interest and then we have compound interest. But when you talk about interest rate and somebody says, I want to do 91-day treasury bill, and then we tell you that the rate is 20%. That 20% that is being quoted to you, it is for 1 year. It is a 1-year rate. So if you want to do just 91 days, which is 3 months, then it means that you will only get 3 months equivalent of the 20% and not the full 20%. If you want the full 20%, then you probably would have to be rolling over till it is 1 year or do a 1-year investment. Then you get the full rate. But all interest rates are quoted annually. But then depending on how long you hold it, that is the equivalent that you get. So what's a simple interest? I'll just use this previous example. So if you look on my the left side of my screen, let's assume that you invest 10,000, right? And for 182 days, I've indicated here. So this is a 182-day treasury bill invested for 5 years at 13.57%. Yes, that's not the current rate, but let's just assume that the rate is 13.57%. As I've told you, because you are investing it for 182, which is 6 months, you are going to get half the interest every 6 months. So you invest 10,000, interest rate is half the 13.57, 6.79. So at the end of every 6 months, you get 678. What do you do to it? You withdraw it. And then so meaning that they pay you your interest and then you just roll over your principal. Then the principal is invested again. They pay you your interest. You just roll over your principal. So that is simple interest. But then what is compound interest? Compound interest is when you let your interest also make interest for you. So the same example, if you look at the same, we started with 10,000 for 5 years. The first year, the first duration after 6 months, it matures to 10,678 cedis. That 10,678 cedis, you don't take the interest. You don't tell them to pay you your interest because truthfully, this 600 cedis, when they pay you your interest, what are you using it for? You will just spend it. If you roll over, you add that 10,000, that 678 cedis, you add it to your principal. It becomes 10,678 cedis. And then what? We roll over. So you realize that at the end of the period, right, the person who had rolled over would be getting about 20,588. Meanwhile, this person who was doing the simple interest would have already spent this 7,463, will not even be able to account for it. And then at the end of the same match, 5 years, still has just the 10,000. But even though in all he would have had 17,463. So clearly you realize that compound interest is the way to go. This is also another example of compound interest, the power of compound. Look, Albert Einstein said is the eighth, or Isaac Newton, they said it's the eighth wonder of the world. So if you look at this, this is assuming we invest your 50 cedis monthly for this number of years, right? At a rate of conservative rate of 16% per annum. So if you invest 50 cedis for 5 years, 16 every month, this is what you are going to get. So if you're somebody you are targeting let's say you are 20 years 20 years old, and you decide that I'm going to invest for another 20 years towards my retirement or so, and I'm going to do 500 cedis. At your retirement, it means that you are going to get about 863,000. So compound interest really works on the principle of time. Oh, sorry, just a second. Sorry, just give me a second.
If you don't mind, I could share from my end.
No, just a second, please.
Oh.
I would. Okay. Yeah. Let me share my screen. Okay. Yes, please. I hope it's visible now. Okay.
Yes,
now we delve into the options. So yes, the first one that I'll talk about is, because we are running out of Government of Ghana Treasury Bills. So I've already mentioned it. When it comes to Government of Treasury Bills, anything less than 1 year is 1 year or less is a bill. So in Ghana, currently we have 91-day Treasury bill, we have 182-day Treasury bills, and then we have 364 days Treasury bills. What happens is that Treasury bills means that you are literally just lending your money to government, and then government offers to pay you an interest at the end of the period. As I have already said, if the Treasury bill rate is being quoted as 91 day, is being quoted as 20%, know that you are not, at the end of the 91 days, you are not getting the full 20%. You are going to get 91 days equivalent of 20%. So Treasury bills are known to be low risk. I don't, some people say zero risk. I personally don't like saying zero risk, because there have been countries that have defaulted when it comes to their government obligations before. So, but it's low risk. So it's usually the base that you look at when you want to invest in other non-government security. So that is for somebody who wants to just get money consistently. So it's every 3 months. I used to do something in school, which I'm not recommending anybody to do, but you could, some people would invest their school, go and buy Treasury bill with their school fees for 3 months, and then at the end of the period, they get something small. So because Treasury bills are low risk, the interest on it is relatively low compared to other investments. So from Treasury bills, I would move to government notes and bonds. So again, in this case, you are lending your money to government. But the thing with this, unlike Treasury bill, where it is for a shorter period, government bonds are for a longer period. So from 2 years, 3 years, 5 years, we have bonds that are 20 years. It means that you're lending your money to government, but for a longer time. But then the main feature about this is that government pays you interest every 6 months. We call it coupons. So for somebody who maybe for cash flow management, there are some people who say that based on their business or their lifestyle, they'll want to receive money at a particular time, right? Maybe yes. So you can go in for a government bond where government will pay you interest every 6 months. So if you buy a 2-year bond, for instance, around 20, let's assume the rate is 20%, and you invest 10,000 cedis, the rate is 20%. Government is going to pay you 10% of that 20% of that 10,000 every 6 months. So if you buy it we are in June, I think your next in June, July, August, September, October, November. Yes. If you buy it in June, it means that in 6 months you receive your first interest payment. That's a 2-year bond. in November. Then the next one will be in June. Then the next one will be in November, till that on the maturity of the bond, the lifespan of the bond, then government gives you back your principal. So you will just be receiving interest. So if it is a 5-year bond, it means that you receive interest 10 times before government gives you back your principal or your capital that you invested in. Another Government of Ghana notes on board, I could add Euro bonds here, because for government also raises money on the international market. So for people who want to buy, say, Euro bonds, or who earn in dollars or have dollars, right, can also opt for Euro bonds, except that when it comes to Euro bonds, it's quite volatile, it's quite riskier, because again, it's on the international markets, and unlike our domestic markets, information moves prices. So you can buy a bond now and then the price will just drop tomorrow, just like that. So I mean, an Euro bond. So you have to know your personality before you go into that. So that's also another option. And also in that, usually with the Euro bonds, you need like $200,000 if you want to invest in those. But then there are some institutions that can give it to you at a lesser, that can assist you if you have less than that. Another option is the local government or quasi-government bonds. So these are not very popular with people. But then there are institutions, I don't know if you've heard of ESLA, the Energy Sector Levy Act. To redeem the legacy debts, right? Government developed this, this law was passed, the ESLA law was passed, and based on that, a bond was issued. So that bond is also another option. So these bonds are slightly higher than Government of Ghana, because they are not strictly Government of Ghana bonds, and they don't sit on the books of Government of Ghana. You are lending your money to the ESLA, we call it special purpose vehicle. You are lending money to ESLA. Another type of quasi-government bond is Dache bond. That one was issued, it was sponsored by Get Fund. So you know that Get Fund, part of our levies and taxes goes to Get Fund. So what Get Fund said that, okay, sometimes before the money comes, it takes long. So let us rather issue a bond. Let us rather borrow money from investors, so that when the money comes, then we'll use that money to, when we borrow money from the investors, we can now do the project, build the schools and whatnot, so that when the monies from government comes, then we can use it to pay back investors. So ESLA is also another, Dache is also another option for investors to look at, because these ones give you higher than what government would also give you. Then also under the local government, we have what we call cocoa bills. So cocoa bills, the features are just like treasury bills, but usually they are issued for 182 days. Cocoa bills is issued by Cocoa Board. So in this case, you are not lending your money to government, but you are lending your money to Cocoa Board. You are lending your money to Cocoa Board. So again, because Cocoa Board is not government, it's only affiliated to government, you will get a premium over, again, I've already mentioned risk premium. So you get a premium over what government is doing. So if government is doing let's say 20% for 182, Cocoa Board will probably do 23% or 24%, because they are not government, but they are aligned, they are affiliated to government. Another option is fixed deposits. So I'm sure a lot of people are familiar with fixed deposits. So when it comes to fixed deposits, you are giving your money to the company, whoever you are doing the fixed deposits with. Most is often issued by banks, do fixed deposits, microfinances, savings and loans. They issue, rural banks, they issue fixed deposits, so non-bank financial institutions. So again, depending on your risk profile, you can go and give your money to a microfinance for a fixed deposit, 182 day, 91 day or 1 year. The interest that you would be given will be dependent on the risk that is perceived to be associated with that particular company. So you need to know the type, you need to understand the type of business they do to be able to, because we saw that a lot of companies went down during the financial service clean up. So before you do a fixed deposit with an institution, know the type of institution you are investing in. Know your personal risk profile and be certain that they are compensating you for the risk that you are taking with them. Then we have corporate bonds. Corporate bonds are also like the government bonds, except this time it's again like fixed. Instead of giving your money to government, you are giving your money to the financial institution, whoever's corporate bond you are buying. As it stands now, I think we have very few corporate bonds that are listed on the what we call our fixed income market. We have corporate bonds from Eastway, we have Bayport, we have Lesheho, we have a few other companies that have issued corporate bonds. So in this case, if you go and buy the bonds, those bonds to also give you they pay you interest like the government of Ghana bonds every 6 months, except that their rates are higher because they are corporate and they are associated with some level of risk. To shares and equities. I'm sure a lot of people are familiar with this. But so when it comes to investing in shares, you can invest in shares that are listed on the Ghana Stock Exchange or shares that are not listed on the unlisted. So it could be listed on the Ghana Stock Exchange. It could not be listed. It could be unlisted. And then you could also invest in global equities. It's the same principle. Companies come to the market to raise money, or they come and yes, they come to sell some of their shares. So once you buy their share, you become a shareholder of the company. So you make money in two ways when you invest in shares. First of all is the capital appreciation. So for instance, if you bought MTN shares at 0.575 at IPO, 0.75 pesos, and then you at the time you wanted to sell it, you were going to sell it at 1 cedi. That difference is something you would have made. Then again, maybe at the time you were going to sell it, it wasn't performing so well, so it had dropped. If it had dropped to say 50 pesos, which actually happened in the case of MTN after they listed, you would have been making a loss. That is what makes stocks very risky. So that is why when you are going for stocks, you have to have a long-term outlook. So if you know that, look, I am close to it, I am nearing retirement, I don't want to invest for more than 5 years, or I want to invest for 1 year, if I see tomorrow that my 100 cedis have invested, the value is now 80 cedis, it will worry my heart. Then don't go to stocks, because then stocks are not for you. Another way to that you make money is through the dividends, as I've already mentioned. When the company makes profit, they can't decide that, okay, this profit, two things, should we reinvest the profit into the company, or we should just pay it out to investors? If they decide to pay it, it's at the discretion of the directors. If they decide to pay it out to investors, then you get your dividend. But then some companies just make a policy, and a dividend policy, so meaning that every year they would pay dividends. I actually have a client who is invested in an unlisted share and gets very good dividend from them every year. Then we come to my favorite, collective investment schemes. So collective investment schemes here categorize mutual funds, unit trusts, exchange traded funds. So mutual funds and unit trusts are unit trusts are very much alike, meaning that they take, so I've talked about bonds, I've talked about stocks, I've talked about fixed deposits. But some people may say that, okay, I don't have a lot of money to go and do this other investments, because those investments, there's a minimum you need to have to do it, especially the bonds. I don't have a lot of money to go and invest there, so rather I don't have a lot of money, so what do I do? So the resolution then is the collective investment schemes. So what they do is that they take your 50 cedis, they take a company's maybe 1 million, another person's 50,000, put it all together into a pool. So it's a managed pool. And then they use that pool to invest on behalf of the people who brought their money. So the contributors or the shareholders. So now whatever return they make, they now share it amongst all of us. So as I mentioned, yes. So one of the pluses about mutual funds and dividends is that, well, first of all, your portfolio is very diversified. So instead of taking your own 10,000 and going to do an FD, or your own 10,000 and going to buy a stock, when it comes to if you invest in a mutual fund or a collective investment schemes, that same 10,000, you probably have a treasury bill in there, depending on the type of fund you invest in. You probably have a treasury bill in there, you have a bond in there, you have ESLA in there, you have a 10-year bond in there. Depending on the type, again, you may have euro bonds in there, you may have stocks in there. So that your 10,000, a bit of it is in all these other asset classes that I have already mentioned, so that when one of the asset classes is not doing so well, another one, the return in another one will kind of cushion it for you. And also high liquidity. When it comes to collective investment, most of them, depending on the type, again, are really liquid, because you can buy today and then tomorrow you tell them that I don't want again, I want to sell, I want my money, and then you can get your money back. The thing with other bonds, for instance, bonds is that, or corporate bonds, they are not very liquid. So if you want to sell, it will be difficult for them for us to easily sell for you, or maybe the price that will be sold at, may not be favorable. It will make you lose a part of your money. Then flexibility in the sense that, look, you can buy it at any time. You can use any amount. You can walk in today and then walk out tomorrow. Most mutual funds, 50 cedis, 20 cedis, you should be able to buy a mutual fund. Again, and the last one I'll say is professional management. Not all of us have the skill to now decide which security should we include in our portfolio and what's not. But once you buy a mutual fund, you have given the portfolio manager or the fund manager or the portfolio manager, you've given the person your role to manage the portfolio for you. So they decide based on their expertise and research, they decide which securities to include in what. Other investments that you can look at, because of time, I'll just rush to real estate, landed property. You can make a good rental income from them. We can also look at precious metals. We have gold. If you don't have money for the physical gold, we have ETFs that have gold as the underlying asset. So those options are also there. Then we have cryptocurrencies and NFTs. I'm sure a lot of us have heard about cryptos, but know that these are really high risk and very volatile. So, and I personally say that if you don't understand a particular instrument, do not invest in them. So I think I've already mentioned all these. So before you invest, understand the business model, know if the type of investment meets your objective. Why are you going in there? Are you going in there for the long term? So when it comes to mutual funds, there are equity funds, there are balanced funds, there are fixed income funds. So depending on your type of objective and then your risk profile, then you decide which one to go into. Know the historical return of the product, although we say that history does not necessarily predict the future, but once you have an idea of what the fund has, the returns it has done before, it informs you of what could possibly happen. Also be mindful of the fees and expenses associated with the investments you are doing. The reputation of the institution is important. Also, who is regulating this company? So if before you invest in anything, you see anything on social media, they say bring your money, we'll turn it around in 24 hours, and also find out who is regulating that industry. So speaking of regulation, I'll just go through. So regulatory landscape. So Bank of Ghana regulates these people: banks, savings and loan, finances, microfinances, rural community banks, microcredits. Securities and Exchange Commission. So if you see a fund manager or an investment advisor, mutual funds, broker dealers, unit trusts, exchange traded funds, they are all regulated by the Securities and Exchange Commission. And then NPR, Pensions Regulatory, regulates pension fund managers, corporate trustees, and individual trustees. So just as a brief overview, I know this I have rushed through, but I'm sure we may get to answer a lot of the questions in the Q&A session. Thank you.
Thanks, Sarah. You really got us into the investment mood. I wasn't expecting us to end, but thanks very much for the presentation. Please, if you have any question, you could put it in the chat or you could raise your hands. Prior to this, we have received certain questions from individuals. So Sarah will take it one at a time. So the first question is, today I've heard about corporate bonds, I've heard about government bonds, energy legacy bonds. How do I invest in bonds? Do I just walk to my bank or talk to my relationship manager that I want to invest in bonds and I get it done?
Yeah, so that's the reason why. So that's the reason why you should know who regulates the firm. So the thing is, when you want to, if anything that has to do with investments, right? Your go-to place is an institution regulated by the Securities and Exchange Commission. Because if you go to an investment firm, they have the expertise to let you know that yes, these options are available. So then you just go to your an investment firm, that is a fund management, an investment advisory firm. In fact, when you go to securities and sec.gov.gh, you would have a list of all the licensed fund managers, and any of them should be able to advise you and recommend securities for you, and then will be able to facilitate the purchases for you. The thing is, a lot of people just go to their banks, and sometimes, not not to speak ill of the banks, but sometimes the bank is not an investment institution, and even though yes, they may offer to sell some of the investment products, the rates that you would get from the bank would be completely different from what you would get from an investment firm, because the bank is basically looking for cheap cash, right? Capital, CASA, yes, low cost of capital, yes, so that they can lend to people. But investment firms are not necessarily looking for that. So then you are better off going to an investment firm than a commercial bank or an institution regulated by the Bank of Ghana for any of the investment products.
Very clear, Sarah. Investment firm, they are the right to go firms if you want to invest. Okay, so the second question is, with the recent inflation, are investments still attractive, or better said, which investment trends now?
So this question is quite tricky, because unfortunately, as I've mentioned severally, we are not in normal times. Up until for the past 5 or so years, we've actually been within the BOG medium target, which is between 8 to 10%, okay, plus or minus 2. We've been within target. The current surge we are seeing in inflation is mainly attributed to effects from COVID, and then also the Russian-Ukraine war. But then, so having said that, the point is, what have you got to lose? Although, as it stands now, inflation seems to be higher than in most of the investments, the fixed income products, right? When you are doing an investment, you have to have a long-term outlook. This inflationary pressures, they're going to change. Yes, even though in the short term we may continue to see the high surges, it would come back to its estimated or its targeted range. So yes, it is still essential to invest. And as it stands now, I would say that most experts are recommending you to look at the short end of the curve, i.e., the anything less than 1 year, just because the economy is not so stable. Interest rate regime is not so stable, so that you take advantage of the high end rates at the short end.
Yes, very clear, Sayram. Stephen, before we come to you, a quick one. In diversifying investment, this is from one of our audience. In diversifying investment with an institution, which one is better? Different products from one institution or different institutions altogether?
I think it depends on the type of institution, because if you go to a fund manager, right, usually what fund managers do is that if they construct a portfolio for you within one fund management, they'll probably already invest your funds in products run by different investment firms. So for instance, if you come to assuming Finance Gem is an asset management institution, a fund management institution, then you go there. Depending on your risk profile and then your objectives, Finance Gem will buy you, probably would include treasury bill in your portfolio, could buy you if it could buy you a unit trust or from from Serum company, or include other different products within the portfolio. So it's I wouldn't say it's one answer fits all. But if you decide to go and do an FD with, say, a savings and loans, and you decide to do 91 days, 182 day, and maybe buy 1 year, different products through that, so you haven't necessarily, you have diversified, but it's not necessary, you haven't really spread your risk because it's still centered around the same institution. So it really depends on the type of portfolio that has been constructed for you. So because you can be with one fund manager. So for instance, in my firm, we have people, some of my clients, they have funds with other fund management they have funds in investment products managed by other fund management institutions. So yes, it depends on the institution that you give to manage your funds, and then the strategy the portfolio manager is deploying.
Thanks, Seyiram. So we'll move to the chat. The first question is from Victoria Akun-Owusu. Where does secondary markets come in? Is it bond or treasury bill? Or could it be both?
Yeah. Okay, so it could actually be both. So let me explain it in simple terms. So there are two markets. We have the primary market and then we have the secondary market. The primary market, let's say the issuer, in this case, if it is Government of Ghana, comes and do donkomi wholesale, right? And then sell. So whoever gives their money is buying it at wholesale price. That's the primary market. And you may get it at a better rate, right? So that's depending on the times. You get it at a better rate. That's the primary market. It could be treasury. That's treasury bill. That's it every Friday when it comes to treasury bill. Bonds, it's done periodically. There's a calendar and then it is announced. Then once it is sold on the primary market, it is sold to wholesalers, right? And other individuals who come to buy it at the donkomi price. Then once that wholesale price window is closed, all the people who bought it can now decide from the next day to start selling it. So that one, you are no longer buying it from the issuer himself. You are buying it from other people, other investors who went to buy from the issuer, and then they are now selling to you. So that becomes a secondary market. So obviously, if they are selling to you, they will get to place margins. So it's just like anything like Accra. You get to you put your interest on this wall, you get to place margins on it and then sell. So that becomes the secondary market. And Government of Ghana securities, whether treasury bills or bonds, are that's why we say they are very liquid. There's always somebody wanting to buy or sell. So on the secondary market, so when you are buying on the secondary market, depending on the type of security or the time that you are buying, you may be getting it at a better deal than the wholesaler, than getting it on the primary market. So it could apply to both.
Okay. Prince, just give us a minute. Let's pick the last question in the chat. If I'm your client, say this one is, you have a client already, which investment would you recommend?
If you were my client, I would ask a number of questions first. I would want to know your risk profile. I would want to know how long you intend to invest. I would want to know your money mindset. I would want to know a lot of things before I can't just make a recommendation to you. So if you want to be my client, there are so many questions I would have to ask before we can recommend investments to you. You don't just up and then recommend. For I don't even know your age, and then I may go and say buy stocks. Probably you are 2 years to retirement, and then you go invest your money on the stock market, and then the stock market is not doing so well, and then you say this investment firm didn't advise me or didn't give me the right recommendation. So a lot of factors go into determining what securities to recommend to individuals.
Okay. So Sayuram, Prince, pardon us, your hand had been up for a while, so you can unmute and ask your question. Prince Nyako.
Hello, good evening.
Hi,
good evening.
All right, so I would like to first of all say that was an insightful presentation from Seram, and it's a great work you girls are doing, and I pray that you continue bringing us good content for us to always be educated and be on our guard. Just to chip in with regards to investing, I think there is now a new thing that is going on where insurance companies are also now seen selling investment policies. And just to let our listeners on the call be aware that anytime you buy an investment through a life insurance company, you're basically shooting yourself in the foot. You will just waste your money. So if it's insurance that you want, go and purchase just the risk aspect and go and do a separate investment with the right people who are licensed to do investments in Ghana, and you make maximum returns on your money. Thank you very much.
Very clear.
Thank you, Prince. Thank you very much. That was very much.
Yeah, it was on insurance, and the speaker made it clear that insurance companies are for insurance. If you really want investment, you have to go to the real people. Thank you very much. So Sayuram,
yes, please.
For now, I'm sure a lot of people have other questions, so I'll give you the platform. How could our audience reach out to you even after today's call? Our investment friend.
Yeah, so you could actually follow us on Instagram, investment friend. We have a page where we share tips on investment tips, saving tips. Yes, you could actually just reach out to us via Instagram on investment friend, and then I'm sure we'll be able to take up a lot more questions from there, and then just personal finance management, we would be able to assist you.
Any closing remarks from you, Sayuram?
So yes, I'll just say that, look, when it comes to investment, there's a saying that says the best time to have invested was yesterday. The next best time is now. So take advantage of opportunities available to you. I've already highlighted what my favorite or which are collective investment schemes. Look, there are so many of them now. When you go onto the SEC website, you would find a list. There are so many of them. There are people now who want to invest in the global. They've been seeing Apple shares and blah, blah, blah. They want to invest. Unfortunately, there's no platform in Ghana that allows you to do that directly. But there are mutual funds and collective investment schemes managed by fund managers that are allowing that, which you can buy into for you to get exposure to these global markets. So there's a wealth of information out there. So if you haven't started investing, nobody makes money through savings. Like if your money is in a savings account, your money is in Susu, you are doing so, you've joined 10,000 Susu groups. It's not going to help you. That is not what is going to make you rich. And we need to break the cycle of using our children as our retirement plans. So let's start planning now. Let's start investing for a better tomorrow. Thank you.
Thank you very much, Sayuram. I guess for today, we have really invested into our future, spending this close to 1 hour with you. Thank you very much from our audience. We really appreciate it. And I'm sure that we will have to come back because we couldn't even finish all the investment.
Yes.
But we really appreciate your time, your efforts, your patience, and truly do expect us to contact you for more investment advice.
You're
Please, we'll be in a group picture So whilst we turn on our cameras and get ready for the post, we are being reminded for this session and the past ones that we have been running for close to a year now, you could get all these recordings on the Finance Gem YouTube channel. Thanks for those who have already subscribed and already watched this video. These are practical videos. The link is there. I'll share it as well in my daily tips. And I encourage all of us, let's subscribe to the Finance Gem YouTube video. Let's see, our cameras are on. As many as you can. So Angie, you take it up from here. You let us know when you are ready.
Okay. Thanks, Jamie. Thanks, Seram, for the insightful session. Please, can you stop sharing your screen so we can get the pictures in the collage? Yes, thanks very much. Okay, so I'll take a few seconds to take the picture. So I would like you to smile for a few seconds whilst I take the screenshot. So keep smiling. Okay, keep smiling, keep smiling. I'll have to take a few more pages because we are many. So keep smiling, keep smiling, keep smiling. And thanks everyone. And hopefully we'll see you in the next session. Okay, thanks everyone.
Thank you. Continue as we have had our practical session. Let's get ready for the next topic. I'm sure that's also going to be exciting. Thank you all for joining today's session. It's 7 o'clock on the dot. Enjoy the rest of the week.
Bye, everyone.
Thank you. Bye.
Thank you. Bye.
Bye-bye.
Thank you. Bye-bye.
Take care.